When you retire, it doesn't matter how much money you've saved. If those funds don't translate into a healthy lifetime income, you're going to be facing a lot of stress in your golden years. That's why it's so important to have a strategy for ongoing lifetime income after retirement. Outside of a pension and regular Social Security, you might not know how to create an income while preserving your savings. Hi, I'm Thomas Mahoney. Today I'm going to show you 4 surprising ways you can do just that. 1. Create income with an annuity. Annuities are a great way to replace the long-lost private sector pension. With a fixed indexed annuity, you can gain the confidence of a lifetime income, as well as principal protection and upside potential. Because fixed index annuities are tied to chosen stock indices. You can make gains as those indices are rising, but you also enjoy built-in protection that prevent losses should those indexes fall. The amount of your lifetime income will vary depending on your principal and the date in which you trigger the payments. Number 2, create and preserve income with life insurance. The right life insurance policy, namely a permanent policy, will have cash value accumulation that can provide a source of funds in later years. Once cash values have grown, they can be accessed for tax-free loans and used to help supplement your post-retirement income, paying for expenses that threaten to burst your post-retirement budget. Life insurance policies, well, they can also provide protection for your future legacy, so you don't feel as if you can't spend your savings to support yourself during retirement. Number 3, increased income by maximizing Social Security. Social Security adjusts your total income payout based upon your age at the time you file for benefits. File before you reach full retirement age, and you will quickly cut your lifetime benefits substantially. Wait until after full retirement age, and you can gain an extra 8% per year up to age 70. For some married couples, waiting doesn't seem like an option as they struggle to make ends meet. That, however, can be remedied by blending 2 Social Security strategies called restricted application and file and suspend. When you file a restricted application at full retirement age, you can receive payments of 50% of your spouse's benefit while leaving yours untouched, so you can gain those delayed retirement credits. Your spouse must file for benefits before you can file a restricted benefit. But if your spouse also wants to get delayed retirement credits, he or she can simply file and suspend the benefits so they aren't paid out until a later date. Number 4, consider a bond, CD, or an annuity ladder. Fixed investments offer a conservative way to preserve principal and gain interest, which can be used as income. But with interest rates as low as they are now, fixed investments can be dangerous, locking you into a return that can't possibly keep up with inflation. In order to beat this interest rate risk and still use vehicles like immediate annuities, bonds, and CDs for income, you can ladder your vehicles by purchasing varying maturity dates so that there is always some principal being freed up to reinvest as interest rates rise. One of the most important tools to any post-retirement income strategy is a knowledgeable advisor. He or she can help you create a detailed plan that preserves capital, produces a predictable lifetime income, and hedges against various risks. Be sure to contact your financial advisor to help you design an income strategy to fulfill all of your retirement goals.